Today's message boils down to two critical points. First, sell your shares in the Korean KOSPI and NASDAQ markets, which have become abnormally and dangerously overvalued. Second, immediately move your capital to the U.S. NASDAQ market, a market that is resilient to economic crises and, by comparison, remains significantly undervalued. Hello, viewers. If you turn on the news lately, it's all about the stock market. You hear that the KOSPI has broken the 6,000-point barrier, and that the NASDAQ is a raging bull market. It's an endless stream of stock talk. And when you hear stories of friends and neighbors making a fortune, it's natural to feel a sense of urgency, a fear of missing out. But to my investors in their 50s and 60s, I have a serious warning. If you let this speculative frenzy sweep you away and pour your life's savings, the nest egg you've worked your entire life to build, into the Korean market right now, you could be heading for financial disaster. My name is Yeo Woonbong. My career began with hands-on experience in a domestic Korean bank and was forged in the world of high-stakes investment on Wall Street. For the past 2 decades, I have also been a university professor, teaching finance and economics. Let's take a hard, sober look at why the Korean market is surging. According to statistics, the KOSPI has soared this year. The government's Corporate Value Up program, designed to boost company valuations, has inflated expectations to a fever pitch. Add to that the promise of dividend tax cuts, and you have a market flooded with money-chasing hype. It's also true that semiconductor giants like SK Hynix and Samsung Electronics have posted strong earnings thanks to the AI boom. In fact, semiconductors account for a staggering 85% of South Korea's total exports. This reveals a dangerously imbalanced and unstable economic structure. But you must look past the headlines to the underlying reality. Why are so many young people betting their futures on stocks? According to 2024 statistics, it takes 14 years of saving every single penny, without spending anything, to buy a home in Seoul. The younger generation, completely priced out of the real estate market, has given up on property ownership. Instead, they are pouring every last bit of their Yonkyul, soul gathering, savings into the stock market. What this means is that the current Korean market is severely overheated, driven not by genuine corporate fundamentals but by a volatile mix of speculative hope and frantic capital. Showing up late to a party often means you'll be the one left holding the bomb when the music stops. So, where should we turn? The answer is the United States. While the Korean market has been caught in this speculative bubble, the U.S. NASDAQ, home to the world's most dominant companies, has been taking a breather. Weighed down by discussions of geopolitical tensions, it has actually pulled back by over 4%. Instead of losing sleep, anxiously checking your smartphone every day while your money is tied up in the Korean market, now is the perfect time to pivot. This is a golden opportunity to shift your focus to the U.S. NASDAQ, a market with undeniable future growth potential, now available at a discount. Now, when it comes to U.S. stocks, many experts will unanimously advise you to buy into the stable S&P 500 index. I've even said so myself in previous videos. And they're right. If you're a young professional in your 30s with a 30 or 40-year investment horizon, making regular monthly investments into an S&P 500 fund is the textbook strategy. But for those of you in your 50s and 60s, who are either nearing retirement or have already retired, your situation is completely different. This is especially true for investors in their 40s to 60s who haven't saved enough and have limited funds. You simply don't have the luxury of waiting 20 or 30 years. With an investment timeline of maybe 10 years, you are in a race against time. You need to leverage your limited capital to achieve the highest possible compound returns to rapidly grow your retirement funds. In this scenario, a tech-focused investment in the U.S. NASDAQ market can be a far more effective strategy than the slower, albeit safer, S&P 500. The data from the last decade proves my point. Over the past 10 years, the S&P 500 index delivered an impressive average annual return of 19%. During that same period, the NASDAQ 100 index soared by an average of 23% per year. A 4% difference might seem small on paper, but when compounded year after year, it results in a monumental difference in your account balance a decade down the line. What is the NASDAQ? It's a veritable black hole for global innovation, pulling in the world's brightest minds, astronomical sums of capital, and world-changing technologies like AI and robotics. Even if an unforeseen economic downturn hits, the companies that will shape humanity's future are overwhelmingly listed on the NASDAQ. The market is fundamentally structured to trend upwards over the next 10, 20 years. This is an undeniable truth. Hearing this, you might be tempted to think, if the NASDAQ is so great, I'll just go all in on Apple, Tesla, and Nvidia and get rich. Absolutely not. Even within the powerful NASDAQ market, betting your entire life savings on one or two individual stocks is incredibly risky. The world is changing at a dizzying pace. In 10 years, Tesla could be bankrupt, and a new company could emerge to eclipse Nvidia. No one can predict the future with certainty. That's why, for risk-averse investors seeking stable growth, the solution is to invest in a NASDAQ index ETF. The most representative NASDAQ 100 ETF I recommend is QQQ. For an even better option, I strongly suggest QQQM, which tracks the exact same index as QQQ but with a significantly lower expense ratio. The reason a NASDAQ ETF is the perfect vehicle for investors in their 50s and 60s is because of a powerful, built-in mechanism, automatic rebalancing. Let me explain what this means in simple terms. Think of an ETF as a magic basket of apples. It automatically identifies and removes any apples that are starting to rot, and then, just as automatically, it fills the empty space with fresh, delicious new ones. A perfect example of this happened in July 2023. The top 7 companies, including Microsoft, Apple, and Nvidia, were performing so well that they grew to represent a massive 55% of the entire ETF. Recognizing this concentration risk, the NASDAQ index triggered a special rebalancing. It mechanically trimmed Microsoft's weight from 12% down to 9% and forcibly reduced the combined weight of the top 7 companies to 40%. The ETF automatically prevented a few overweight stocks from jeopardizing the health of the entire fund. While you sleep, the ETF is working for you, identifying and adding companies with high growth potential while ruthlessly culling those that lose their competitive edge. You don't need to spend your days with a magnifying glass, agonizing over financial news and stock picks. World-class investment managers and sophisticated systems are managing your money for you. All you have to do is buy one ETF and rest easy at night, knowing you've secured a strategy that is both safe and poised for high returns. Now let's cover a crucial point for protecting your retirement savings. When you buy a NASDAQ ETF, I strongly urge you not to buy the version listed on the Korean market in won. Instead, you should convert your currency to U.S. dollars and invest directly in the U.S. listed ETF. Why go through the extra step of converting to dollars? It's all about hedging against currency risk, building a defensive wall for the next economic crisis. When a future crisis hits, what do you think will happen? Foreign investors will pull their capital out of Korea, causing the value of the Korean won to plummet and the KOSPI and KOSDAQ markets to crash. But the U.S. dollar, the world's primary reserve currency, behaves differently. During times of global economic uncertainty, its value soars. So, even if the price of your U.S. stocks takes a temporary hit during a downturn, the surge in the dollar's value can cushion or even completely offset those losses. Your dollar-denominated assets become a financial fortress. This is a fundamental and powerful principle of finance, utilized by everyone from individual investors to giant institutional funds. That is why at least 50% of your total assets should be held in U.S. dollars. It is the key to surviving any domestic or global economic storm. Take a moment right now and look at your portfolio. What percentage of it is in U.S. dollar assets? If the answer is 0, you need to make a change immediately. Do you know what savvy Korean retail investors, the seohak gamey, are already doing? In the first quarter of 2024 alone, they net purchased $1.94 billion worth of U.S. stocks. That's an astonishing 43% jump compared to the same period last year. This is clear evidence that smart money is already exiting the Korean bubble, converting their assets to dollars, and seeking refuge in the U.S. market. Some pundits claim these investors are missing out on the Korean rally and floundering in the U.S. market. I completely disagree. If my words sound like mere YouTube hyperbole, then let's look at the report cards of the world's most successful institutional investors, the major pension funds. The Canada Pension Plan, CPP, boasts some of the best returns in the world. Its total assets exceed $780 billion. But do you know how much of that is invested in its home country of Canada? A mere 12%. And where is the rest? A massive 47% is poured into the U.S. market. To protect itself from domestic economic risks, the CPP has diversified over 85% of its assets internationally. Now let's look at our own National Pension Service of Korea. In its 2026 fund management plan, the target allocation for domestic Korean stocks is just 14. The target for overseas stocks? When you factor in alternative investments, the fund's total overseas exposure is already approaching 60%. If South Korea's sharpest financial minds, tasked with protecting the nation's retirement funds, are actively moving away from the Korean market and building a defensive wall with dollar assets, it would be reckless for individual investors to ignore their lead. Of course, I know some of you in your 50s and 60s might be thinking, this is all too complicated. Converting currency and buying U.S. stocks on my smartphone. I can't do it. But don't give up. There is still a way. Go to your bank or brokerage firm and open tax-advantaged accounts like an ISA, a pension savings account, or an IRP. If you have an income, you can receive significant tax deductions. The ISA account offers incredible tax benefits on your investment gains. However, these tax benefits only matter if you're actually making a profit. If your investments are losing money, the tax advantages are worthless. Therefore, within these precious tax-sheltered accounts, I urge you, do not buy individual Korean stocks. Fill them with U.S. NASDAQ 100 ETFs that are listed on the domestic exchange. Viewers, please do not make a mistake you'll regret for the rest of your life by jumping into an overhyped Korean stock just because everyone else is supposedly making money. The only real answer for those of us in our 50s and 60s to safely and swiftly navigate the challenges of retirement is this. Entrust half of your assets to a dollar-based investment in a NASDAQ ETF, a fund that holds the keys to future technology and automatically rebalances your portfolio for you, all while providing a shield against economic crises. If today's video helped you protect your financial future, please subscribe and hit the like button. A line or two of encouragement in the comments would also mean the world to me. And I have one more request. Please share your own experiences, both successes and failures, with ETF investing in the comments below. It is incredibly valuable for our community of subscribers to learn from each other's journeys. Thank you.